Most people think a credit score is just a number that tells lenders whether you're responsible. It's not. It's a pricing tool. And depending on your score, it's quietly adding tens of thousands of dollars to every major purchase you make. Here's the actual mechanism. The lower your credit score, the higher the interest rate you get charged. And the higher the interest rate, the more money drains out of your life over the long run. We're not talking about a few $100s. On a $300,000 mortgage, the difference between a 620 credit score and a 760 credit score can cost you over $80,000 in extra interest payments. That's not a small penalty. That's a second car. It's years of retirement savings. It's real money, permanently gone. And most people have no idea this is happening to them. This isn't something that only affects people who are bad with money. It affects anyone who has ever financed a car, rented an apartment, applied for a credit card, or bought a home. It affects you if you're young and just starting to build credit. It affects you if you went through a tough period financially, a job loss, a medical bill, a divorce, and your score took a hit. It even affects you if you've never missed a payment in your life, but you're carrying too much credit card debt relative to your limit. The credit scoring system doesn't just judge whether you'll pay back a loan. It determines exactly how much extra you'll pay for the privilege of borrowing for the rest of your life. And the part most people miss is this. The damage isn't just on your mortgage. Your credit score affects your car loan rate, your insurance premiums, whether a landlord approves you, and what deposit you pay for utilities. It's one number. And it reaches into almost every financial transaction you will ever make. Here's how this works, as simply as possible. When you borrow money, the lender is taking a risk. You might not pay it back. To account for that risk, they charge interest. The more likely they think you are to default, the higher the interest rate they charge. Your credit score is their shorthand for that risk. A high score, say 760 or above, tells lenders you almost always pay on time, so they charge you less. A low score, say 620, tells lenders there's a meaningful chance something goes wrong, so they charge you more. So far, this seems fair. It's just math. But here's what makes it a trap. The people most likely to have low credit scores are also the people with the least money. They're the ones who can least afford to pay higher interest rates. And yet, they're the ones who get charged the most. The system takes people who are already financially stressed and makes every loan they take out more expensive. That extra cost makes it harder to build savings, harder to stay current on payments, which keeps their score low, which keeps their rates high. It's a loop, and once you're in it, it takes real effort to get out. Let's look at Daniel. Daniel is 29 years old. He lives in Austin, Texas. He works as a logistics coordinator and earns $62,000 a year. In 2021, Daniel had a credit score of 634. It wasn't because he was irresponsible. 2 years earlier, he'd lost his job during the pandemic, fell behind on 2 credit card payments, and carried a high balance for about 8 months. He caught up, paid everything off, got back on track. But those missed payments were still sitting on his report. In 2021, he bought a house. Price, $285,000. Down payment, $28,500. Loan, $256,500. Because of his 634 score, his lender offered him a 30-year mortgage at 6.8%. His monthly payment, $1,678. Total interest paid over 30 years, $347,580. Now let's run the same numbers for his coworker, James. Same income, same neighborhood, same house price, same loan amount. James had a credit score of 768 because he'd never had a financial disruption. His rate, 5.9%. His monthly payment, $1,522. Total interest paid over 30 years, $291,920. The difference, $55,660. Same house, same loan, same income. Daniel paid $55,660 more, over $1,800 extra per year, simply because his score was 134 points lower. And he had absolutely no idea this was happening when he signed. No lender explained it that way. Nobody sat him down and said, "Your score is going to cost you $55,000 on this house." They just gave him a rate. He signed. And the math quietly did its work over the next 30 years. This is the part that doesn't make headlines. The losses aren't felt in one moment. They're spread across hundreds of monthly payments. Invisible, normalized, accepted as just the cost of buying a house. But it's not the cost of buying a house. It's the cost of having the wrong number in a database. Now here's where it gets bigger. Because the mortgage is just one piece. Let's add the car loan. Daniel also financed a used car in 2022. A $22,000 Toyota Camry, financed over 60 months. With his 634 score, he got a rate of 11.2%. Monthly payment, $481. Total interest, $6,860. James, with his 768 score, got a rate of 5.4%. Monthly payment, $424. Total interest, $3,440. Difference, $3,420 on a single car loan. Now, let's add auto insurance. This one surprises people. Most states allow insurance companies to use your credit score when setting your premium. Not your driving record, your credit score. A 2023 analysis by the Consumer Federation of America found that drivers with poor credit pay up to 76% more for auto insurance than drivers with excellent credit, even if their driving record is identical. On a $1,400 annual premium, that's an extra $1,064 per year. Over 10 years, more than $10,000. When you add up mortgage, car loan, and insurance across a decade, the gap between Daniel's score and James's score costs Daniel roughly $90,000 to $100,000 in extra payments. Same income, same city, same lifestyle. One person paid 6 figures more because of a number. And crucially, none of these extra costs show up as a line item anywhere. Daniel doesn't get a bill that says, credit score surcharge, $1,800. It's just baked into his monthly mortgage payment, his car payment, his insurance renewal. Most people look at their monthly bills and see numbers they eventually get used to. They don't compare them to what someone else with a higher score is paying for the exact same things. The cost is real. It's just invisible. There's a second force at work here that most people never consider. The credit scoring system isn't just measuring your financial behavior. It's measuring very specific things, in very specific ways, that systematically favor people who are already financially stable. One of the biggest factors in your credit score is something called credit utilization. This is the ratio of how much credit you're using compared to your total credit limit. If you have a $10,000 credit limit and you're carrying a $3,000 balance, your utilization is 30%. Experts say you want to stay below 30% to protect your score. But here's the problem. If you only have a $2,000 credit limit because you're young or because you've never built credit history, and you put $700 on your card one month, you're already at 35%. You didn't do anything wrong. You just have a low limit. The system penalizes you not for how you behave, but for how much credit you've been given. And who gets high credit limits? People who already have good credit scores and high incomes. It's circular. People with access to more credit can maintain lower utilization. Lower utilization produces higher scores. Higher scores get them access to more credit. There's a second factor that works the same way: length of credit history. The longer you've had credit accounts open, the better it is for your score. This means someone who opened a credit card at 22 has a built-in advantage over someone who only started using credit at 30. Age and stability, not just behavior, are baked into the system. If you started late, you're already behind. Let's step back and look at the full picture. There are 3 major credit bureaus in the United States: Equifax, Experian, and TransUnion. They collect your financial data. They sell it to lenders. And the most widely used score they produce, the FICO score, was developed not to help you, but to help lenders quickly price the risk of lending to you. That's a subtle but important distinction. The score wasn't designed to be fair. It was designed to be useful for lenders. And because it's now used for housing, car loans, insurance, employment background checks, and utility deposits, it has become one of the most consequential numbers in your life. Here's something else worth knowing: your credit score can contain errors. A 2021 study by the Consumer Financial Protection Bureau found that roughly 1 in 5 Americans has an error on at least one of their credit reports. Some of those errors are minor, but some are serious. A payment wrongly marked as missed, a debt that doesn't belong to you, an account that should have been closed. And unless you check your report, which most people don't do regularly, those errors sit there, silently raising your rates for years. You're not just being judged by your financial history. You're potentially being judged by someone else's financial history by mistake. Here's the counterintuitive part. The behaviors that most improve your credit score are not necessarily the behaviors that actually make you financially healthy. The single most impactful thing you can do for your FICO score is to keep credit cards open and make small purchases on them every month, even if you don't need to borrow. The system rewards you for having active credit relationships, not for saving, not for living within your means, not for accumulating assets. Saving $30,000 in a bank account does nothing for your credit score. Keeping a credit card you rarely use does. This creates a strange incentive. The credit system is designed around participation in debt, using credit, cycling it, managing it actively. If you avoid debt entirely, you may actually have no score at all. The technical term is credit invisible, and the Consumer Financial Protection Bureau estimates that about 26 million Americans fall into this category. They may have 0 debt, 0 missed payments, 0 financial problems. But because they don't actively participate in the credit system, they're treated as high risk, and they often can't get a mortgage, a car loan, or even an apartment without paying extra deposits. Paradox. The people who avoid debt the most carefully can end up paying the highest premiums when they finally need to borrow. There's also a racial dimension to this that researchers have documented. A 2022 study published in the journal Economic Geography found that Black and Hispanic Americans have systematically lower credit scores on average, not primarily because of different financial behavior, but because of differences in generational wealth, access to credit products, and housing history that are themselves the legacy of discriminatory policies. Redlining, which prevented Black families from buying homes in appreciating neighborhoods for decades, didn't just limit wealth at the time. It limited credit history. It limited the intergenerational transmission of home ownership. And it limited the score-building infrastructure that white families built over generations. The scoring system doesn't see any of that history. It sees a number, and it charges accordingly. So here's what's actually happening. The credit scoring system doesn't just track your financial behavior. It charges you a A hidden, compounding tax on every loan, every premium, every deposit, based on a number most people barely understand. And the size of that tax is enormous. Over a lifetime of borrowing, a mortgage, 2 or 3 car loans, insurance payments, the gap between a 620 score and a 760 score can easily exceed $100,000. Not because you did anything wrong, not because you were irresponsible, but because you didn't know the rules of the game you were already playing. The system was built to help lenders manage risk. It was never built to help you build wealth. Those are two completely different goals. And for decades, most people have assumed they were the same thing. They're not. The score doesn't measure your financial intelligence, your discipline, or your character. It measures how useful you've been to the credit industry. And the less useful you've been, the less you've borrowed, the shorter your history, the less time you've spent inside their system, the more it costs you when you finally need to get in. That's not a flaw in the system. That's the system working exactly as it was designed.